All right, let's get right into it. Welcome to today's Institutional Briefing Explainer. I'm putting on my senior market strategist hat today because we need to forensically deconstruct the structural risk and, frankly, the extreme market volatility we saw on June 19, 2026. We are looking at a session that literally tested the absolute limits of algorithmic governance in geopolitical pricing. So let's unpack what actually happened.
Here's our roadmap for the deterministic A analysis. We'll cover the market structural setup, the June 19th gap trap, micro and macro bias workflows, do a trap versus real analysis, factor in the geopolitical friction and proxies, and finally wrap up with our institutional predictive conclusion.
Starting off with Section 1, the market structural setup.
Okay, so we're starting right at the scene of the incident. Think of it as a sudden, jarring transition from structural optimism straight into this visceral liquidity void. Just look at the pre-market gap down to 23,991.20. It was wild. I mean, on June 18th, we were sitting pretty with a robust bullish posture, closing with a +6 bias. But by the pre-market of the 19th, wow. Our convolutional neural network agents mapped a massive spatial void against our macro boundaries. The market essentially just vanished right into this gap trap.
Now, while we're analyzing this void, we really have to remember that older charts still have multiple unfilled empty gap ups sitting way below the current price action. In deterministic analysis, these unfilled gaps act like a structural vacuum. It's a persistent gravitational pull. Basically, it creates a constant looming vulnerability and a downward target for the market the second structural support starts to fracture.
Moving right along to Section 2, the June 19 gap trap.
So, shifting over to the live session, we really need to observe how the analytical agentic system managed this extreme structural shock. The market context protocol kicked in and activated its constraint-based logic. As the market plunged, price violently detached from the structural boundaries of our moving averages. But, and this is key, instead of letting momentum models blindly sell into the abyss, the system recognized deeper support zones. It actually enacted volatility gating to halt that runaway selling. Honestly, it's an absolute masterclass in governance over guesswork.
Up next, Section 3, Micro and Macro Bias Workflows.
Let's see how all this translates into our deterministic readings throughout the day. By 9:27 a.m., temporal agents, specifically the LSTM networks tracking momentum over time, registered a severe, strong bearish micro-level rejection signal, -22. At that exact moment, you can imagine, the pressure on institutional portfolios was just immense.
But here's where it gets really interesting. Deterministic governance actually prevented a total regime collapse. Notice the progression in magnitude here. From that devastating -22 morning low, buyers stepped in and executed a high-magnitude intraday reversal, eventually closing the micro time frame at a strong bullish +16. And all the while, the overarching daily macro time frame just completely absorbed the shock, staying rigidly neutral right at zero.
This forensic audit maps the 9-step deterministic workflow, showing us exactly how that violent upward impulse reclaimed all its structural anchors. The system correctly prioritized the magnitude of the 6 strong bull bars at the end of the day over the 53 preceding bearish bars. It's a stunning representation of how noise filtration and autoencoders stop false breakdown signals, allowing the true, winning regime to emerge from all that morning chaos.
Which brings us to Section 4, Trap versus Real Analysis.
To really grasp the true nature of this movement, we absolutely have to contrast it with a recent anomaly. The crucial takeaway here is the difference between June 17's deceptive gap-up trap and June 19's gap-down trap. On the 17th, we had this hollow visual gap-up that totally lacked underlying support, and it ended in a violent bearish gate. But on the 19th, the market gapped down. Buyers were practically forced to genuinely build structural support from the floor up, which created a high-magnitude bullish reversal.
Looking back at the June 17th chart, it's super clear how unconditioned momentum models got trapped. They saw visual strength at the open, but the underlying moving averages were lagging way out of sync below. Before the day even ended, rigorous volatility gating stripped away those bullish weights, plunging the framework down to a -16. The 19th survived precisely because it didn't rely on that kind of hollow optimism.
Section 5, Geopolitical Friction and Proxies.
Now, as an institutional strategist, I had to emphasize mapping these algorithmic workflows directly to the geopolitical layers driving the capital flows. This table perfectly organizes the dual-natured reality we're currently trading in.
At the macro layer, the US-Iran Interim Peace Memorandum gives us a neutral macro score of 0. A bit of structural relief there. But down at the micro layer, that severe morning gap down to 23,991, that was a direct, visceral reaction to the heavy fighting and escalation in the Israel-Hezbollah proxy conflict.
As our geopolitical analysts accurately pointed out, June 19 resembles a micro-level bearish rejection against that recovery. Because the core conflict-generating mechanisms, like these proxy networks and regional security competition, they remain fully active. So the market suffers from this persistent re-escalation risk, which translates directly into those micro-level bearish shocks we saw right at the open.
Finally, Section 6, Institutional Predictive Conclusion.
Synthesizing all of this data for our upcoming sessions, here's the deterministic prediction for your portfolio management. The market has basically entered a state of profound multi-time frame divergence. Yes, buyers heroically won the micro battle today with that plus 16 close, but the overarching macro structure remains completely trapped in neutral. And here is the strict warning. Those unfilled, empty gaps down below remain a massive vulnerability. Any new negative shock to this fragile peace framework is going to violently exploit those gaps for a severe downward mean reversion.
So I want to leave you with this provocative thought to consider as you evaluate your exposure to this highly confined, structurally vulnerable market regime. How do you, as a focused investor, weight the brilliance of algorithmic containment against the unpredictable heavy hand of geopolitical re-escalation risk? It's a tough balancing act for sure. Thank you so much for joining me for this explainer. Stay disciplined out there and keep trusting the deterministic workflows.